All right, we are to our last CPA prep, the last book club. Today is kind of the dead day of last. So we had our last quiz today. Everybody's just kind of like saying, "Oh, thank God!" But trust me when I say you're going to miss this. You're going to miss this. You're going to be going into finals week and be like, "I really just want to go back to the quiz day and do that." And, if you really want me to give you a finals week quiz, let me know. I'll throw something at you. I'll put something together. I'm going to do my best today. I'm still kind of suffering from the cold that I had earlier this week. I'm a lot better than I was. The way that I described it, Dr. Caden, though, is that I think I probably said this on Wednesday, but it feels like I took multiple Benadryl and the effect is just leaving me really, really groggy. Has anybody ever taken Benadryl and just kind of had that effect lingering over them? It's just like, all you really want is sleep. That's all I felt like doing for like the past 48 hours. And so, I've gotten plenty of sleep for the past 48 hours, but I still want more. So, the only thing that we can do to combat that is for enthusiasm for CPA prep questions. So I'm going to bring that to you. But first of all, we got to talk about Theranos. So, what happened to Theranos? So, Chapter 24, can anybody see that coming? Chapter 24, Theranos bailed themselves out. They actually managed to come back, and now they're a big public company that's trading in the real world again, and they're making actually, I'm making all that up. Yeah, Theranos was kind of found, they were found out, and we knew that the end was coming, but what was the end? Well, the CLIA, Clinical Lab Inspection Authority, I think that's what it stands for. They actually had Theranos under scrutiny, and they said, we're going to inspect you for 2 days. And they tried to do it over a 2-day period and said, wow, this is just, there's too much going on here. We're going to have to reschedule for some point later. And at some point later came after the Wall Street Journal came out. And so that in November, right after that, they did another investigation, and they basically said, yeah, you guys stink. You've got 10 days to fix some problems. And if you don't fix these problems, we're going to suspend your ability to run blood testing. And sure enough, Theranos basically said, we'll do our best. And, Theranos' best is just not nearly good enough. So I think they said they failed to correct 43 out of 45 deficiencies, which that's just, you got a list of 45 deficiencies and you can fix 2 of those within a 10-day period. You're just not really in the ballpark. So said, yeah, you're not doing blood testing for a 2-year period. And that was kind of the death knell. So then Elizabeth Holmes, she was going to go into this, I had it on the quiz, the AACN presentation, and everybody's like saying, this is a sham. Why should I do that? I was like, they had more viewership for that particular presentation than they ever had before. It was basically a conference. Like, I will tell you right now, if we had something like that for the American Accounting Association, they would jump at the chance for that, just because the American Accounting Association presentations are so boring every year. Basically talking about the future of accounting in the world, and nobody really gets into that. But they had an opportunity, and Elizabeth comes up and she projected her reality distortion field. I love that term, the reality distortion field, where she goes up and changes the way that people perceive things. It was very obvious to see why she was so successful. But then they started getting down to the technical questions, and she was not able to answer any of them. And everybody was like, yeah, you fooled us once, shame on us. Sure, shame on you. Fooled us twice, that's not going to happen. So, yeah. They basically realized that she was trying to pivot into saying that this device that never worked was now somehow working, and it still doesn't work. And Theranos was trying their best to bail out. So they got hit with a flurry of lawsuits, and Sunny was finally let go. We can say goodbye to Sunny, thank God. Good riddance, okay. But Elizabeth's still hanging on, and she basically tried to actually make it out with an angel fund of $100 million at the very end there, but it still didn't work out. Eventually, Theranos was just hit with so much that they finally had to declare that it was over. And, good riddance to bad rubbish, I guess. And now we have all these stories to tell, which is kind of ironic because I love talking about Theranos. And had this never happened, I wouldn't have these great stories to tell or this great book to read that we could actually go through. But, it's like any fraud. It's like it's fun to talk about the stories and how ridiculous everything was, but it's just kind of a tragedy, everything that happened as a result of it. And this one kind of had an interesting human element, but I think that there's a lot of lessons and implications that can be taken away from this, particularly with our profession, with respect to auditing, with respect to like transparency, corporate governance, and just kind of the core control environment of the organization, and the lack of all these existing conditions that we really need for an organization to run well. So hopefully everybody got something out of that. And if you didn't, I'm sorry. At least it was an entertaining read. That that was the whole point. Anyway, let's go ahead and get on to the CPA per question. Which of the following circumstances requires modification of the accountant's report on a review of interim financial information on a publicly held entity prepared on the basis of generally accepted accounting principles? So this is saying we're doing a review of interim review engagements of financial statements, and which of the following conditions would actually result in a modification of the report? And the answer to this question is pretty easy. All right. Before you go into the answer to this question, basically all you need to know is anything that violates the specified reporting framework, in this case, GAAP, okay? Anything that's a violation of the specified reporting framework or a violation of GAAP or a departure from GAAP. So that's all we're looking for in this particular answer. So if we go to A, say an uncertainty, lack of adherence to GAAP, a lack of accounting disclosure, and uncertainty does not fall under that criteria. So A is out because A would not actually fall into that. B, a lack of adherence to a general accepted accounting principle and lack of adequate disclosure, which a lack of adequate disclosure would be a violation of GAAP. Okay, so both of these are violations of GAAP. So B is probably our answer. C is none of the following: uncertainty and accounting change, a lack of adherence to a general accepted accounting principle, or a lack of adequate disclosure. C is not a correct answer for the reasons we talked about why B was. And then D, accounting change, lack of adequate disclosure, lack of adherence to a general accepted accounting principle. Accounting change is not sufficient to create a modification. So B is our only answer. This is not a really well-written question, but it is an important question to be able to understand with respect to how reviews are conducted. According to the profession's ethical standards, an auditor would be considered independent in which of the following situations. So remember that all those rules with respect to the code of professional conduct and independence, all I'm going to tell you is be very, very familiar with those, because there will definitely be questions in this area. It's really good and important to know that just by offhand, but it's important to know for proper in this regard. So the auditor is officially appointed the stock or transfer agent of the client. That would be a very clear violation of independence, because that would be work that we would be performing as an auditor, and we'd be auditing our own work. The auditor's checking account is fully insured by a federal agency held at a client's financial institution. This is an interesting one, because what would happen to the auditor's money if this client was suddenly found to be insolvent, if for some reason they were found in committing a material fraud and the auditor's assets were at risk? And the answer is nothing, because they're fully insured by a federal agency. So this one would be one of those scenarios where the auditor has nothing, the auditor has nothing at risk. So in that scenario, because it is actually fully insured by a federal agency, we can actually say this is fine. Okay, they can hold a checking account because they don't have any compromised independence. They don't have anything at risk here, simply because anything they have at risk is going to be covered by insurance. For that reason, C, the auditor owes more than 2 years prior to the issuance audit fees for more than 2 years prior to the issuance audit report. We talked about that back in 417. If it's over a year old, that represents a long-term interest, which represents an ownership interest, which you can't have that. The client is the only tenant of commercial building owned by the auditor. Well, that's also another relationship that's external to that, but that's a relationship that can't exist. So B is our answer. All right. Keeping on those lines, the Code of Professional Conduct and Independence Rule does not consider which of the following to be a circumstance to be a lack of independence. Okay. So let's just go through these. CPA's sole audit manager served as the auditor controller of the audit client from January 1st, year 1 through May 1st, year 5, when the manager began working with the CPA firm. His current audit period audit client is for April 1st, year 5 through March 31st, year 6. Okay. So basically, this is kind of an odd scenario. This is kind of an opposite of the cooling off period. So the sole audit manager served as controller of the firm's client through year 5, through May for first year 5. Okay. And then the manager began working for the CPA firm. Current audit period overlaps that. So because the current audit period overlaps that, the auditor is not independent from the clients. So that would kind of be a problem with that. So yeah, this is going to be this would basically be a lack of independence because of the overlap there, because they'd be auditing their own work effectively. Auditor's brother-in-law's father is controller of the client being audited. So is brother-in-law's father considered to be a close family relationship? Answer is no. Remember, immediate relationships are going to be spouse or partner and dependents, and then close family relationships would be parents and siblings and non-dependent children. So brother's brother-in-law's father is not close enough to be considered to be somebody close family relationship, so we can say that that's not a violation of independence, and B is our answer. Audit firm is privately held. The auditor provides valuation appraisal services to audit client, the results of which are material to financial statements. Well, that's pretty obvious. The auditor is going to be doing auditing of their own work, which is certainly a violation of independence, even if it's privately held. Finance institution client loans the auditor money to buy a boat, but does not collateralize the loan. Okay, so if we're auditing the financial institution, we would need to have collateralization of the loan, because that would need to be something else. If the bank itself has a problem, then nothing's going to be a risk. Okay, the loan is not collateralized, and the auditor is basically going to say, all right, there's a problem here. I don't want to lose my boat, so there's going to be an issue there, and the auditor may act may act in ways that they normally wouldn't apply. So the fact that the loan is not collateralized is kind of the key there. So that's why that's still a violation of independence. All right. In reporting on internal controls, the Sarbanes-Oxley Act requires the CEO and CFO to sign the report to assert they have disclosed what. So let's go ahead and chop this question up in half, okay? Because there's a question about fraud and significant internal control deficiencies. So the question is, do they have to disclose fraud according to the Sarbanes-Oxley Act? The answer is no. Okay, material fraud does not need to be disclosed. That's something that can be held internally. But internal control deficiencies do need to be disclosed, and the question is to who? And the answer is they do need to be disclosed to both the auditor and to the audit committee. So this is not the auditor disclosing this to the management and the audit committee. This is the management. They have to actually make sure that they have to provide this information to the auditor and the audit committee. This is part of their required disclosure under the Sarbanes-Oxley Act. So this is I believe it's ancillary to Section 404, but I'm not 100% certain on that one. I just do know that management does have a required disclosure with respect to internal control, and that goes to audit committee and issuers auditors. How many companies per year does a CPA firm ever have to, does a CPA firm have to register with the Public Accounting Board, have to perform in order to be subject to mandatory annual inspection by the PCAOB? So keep in mind on the PCAOB, there's two types of inspection brackets. There's the triennial inspection bracket, which basically means that their PCAOB is going to look at them once every 3 years. And there's the annual inspection bracket, which means they look at it every year. The annual inspection bracket is obviously for very, very large auditors. So how big does the auditor have to be? The answer is they have to have at least 100 audit clients per year. Okay, very large number. Currently, I believe the number is 10 of the number of CPA firms that are registered under PCAOB. It's usually always around that. Not very many, but those are the annual firms, which are big four, and then a lot of large regional firms as well. Question 6, I threw this up here just because it's part of the CPA. I don't expect anybody to have known this right off the top of my head. But which of the top following is not true about the Department of Labor's independence guidelines? This is an interesting question in the fact that if you just answer this question from the context of just answering what would be the more standard independence guidelines that would be applicable to an audit, you can answer this question as well. So the first answer says an immaterial direct financial interest that the plan does not impair independence. And keep in mind that the independence guidelines under Code of Professional Conduct says it has to be, you can't have a direct financial interest or a material indirect financial interest. So any direct financial interest, regardless of the size, is going to be a violation of independence. And that's true under the Department of Labor guidelines. So A is our answer on this one. All right, moving on. We got two task-based simulations because this is the final one, and I want you to get your money's worth. Okay, so I want to make sure to do this. So the first one is basically going to be by a code of professional conduct, a violation or no violation. So the guidelines here were saying if you have a violation, if you did not have a violation, you need to identify the rule violated. What I'd like to do is I'd like to talk about the rule that's being referenced here in each situation, regardless of whether there's a violation. But there's a violation, we definitely need to identify which rule is going to be violated. So let's go ahead and take a look here. So the first one is going to be continuation of the use of names Jones and Associates. And this actually refers to information that was on the second exhibit. So Jones and Associates CPA is proud to announce that our 4th consecutive year, all of our employees are members of the ACCT. So to be a member of the ACCT, one of two things has to happen. You have to either be a student in an accounting program that's pursuing your CPA for the future, or you have to be a licensed CPA. Okay, those are the two requirements for CPA. Presumably, they don't have any students that are there, but everybody there is working there as a licensed CPA. So what does that mean? Can they actually use the word or can they use the name Jones and Associates CPAs? Yes, that is fine. Okay, that is fine. That is no violation is going to be present there. So we can actually say no violation. But just as kind of context, the rule that they're talking about is not a violation of this rule. What the rule we're referring to is form of organization and name rule. So basically, you can't actually say that you are all CPAs if not everybody in the firm is CPAs. And that's kind of why you see KPMG and PwC and EY. They don't want to say EY CPAs because they're not all CPAs anymore. HMC gift to audit supervisor. All right, so the audit supervisor is saying, I think the HMC is very happy with their work. The controller gave me a $20 gift certificate for lunch at a local restaurant. Well, that's nice. That's nice. Does that mean they're trying to bribe them with that $20 gift? Is that considered to be large enough to be a bribe? What do you think? Is it yes, no, maybe? How many people think it's a bribe? Not considered. It may try to be a bribe, but it's not considered to be a bribe according to CPA guidelines. According to the code of professional conduct, it has to be at least $50. Okay. So what is it going to be talking about? That's the independence rule that we're referring to. Failure to return HMC to receiver reports. Okay, what's going on here? So I believe the audit staff is transferred to another location, which is why they responded. That's the answer to a question. They've not returned receiver reports to the controller to cite numerous requests. This is the one we talked about. It's like, this is a big no-no, okay? If the client says, give us our documents back and you fail to do it, it is definitely a violation. Question is, which violation is that a rule of? Or which rule is that a violation of? That is our acts discreditable rule. And that's the one that you're going to see most of the time under acts discreditable. In fact, I have never seen a scenario that acts discreditable did not talk about this specific scenario. Where the client requested information back and they did not return it. So that's the acts discreditable rule. Non-GAAP depreciation method. So discuss the non-GAAP method of both in-charge partner and HRC manager to determine the company's method for depreciation was acceptable given the unique industry and necessary for HFC to have misleading financial statements. So they're basically saying that the financial statements would be misleading if we presented them under a GAAP method. So that's why they've employed a non-GAAP method, and they believe that that's appropriate. Is that a violation? It is not a violation. Okay, so that's accounting principles rule, although it's not a violation of this particular rule. So. Lack of review of post-planning work papers. So the senior says, as you noted, I reviewed the staff's work during the planning stage, which so do carry an adequate knowledge. As a result, I did not review the audit work papers during the rest of the engagement due to the high level of confidence I have in our support staff. So that's kind of what I do is that my first exam I review, and if everybody does really well in the first exam, I don't even grade the second exam to just give everybody full credit on those exams because, yeah, high level of knowledge. Obviously, that's silly. Okay. So is that a violation? Yes, we got a violation here. And what is the guidelines here? That actually has to do with general standards, because that's where we talk about due professional care and supervision. And then confidential information provided by an in-charge partner. This is exhibit 2. Exhibit 2. No, it's exhibit 1. Exhibit 3. There we go. Yeah, exhibit 3. That's what I meant to say. In response to the subpoena delivered June 1st, year 4, the related to the pending lawsuit at HMC attached to respond to the client requested confidential documents. What? The auditor provided confidential information? Yes, they did in response to a subpoena, a legal summons. There are 2 scenarios in which you can actually provide confidential information without the approval of the client. The first one is in response to a review board inquiry, which would be like PCAOB. Second would be in response to a legal summons, which is to be a subpoena. So there's no violation here. And this would be the confidential information rule or confidential client information rule. How do we feel about that? Pretty good? Fantastic. All right, last question. All right, so we're going to talk about our favorite thing, the Sarbanes-Oxley Act. We're going to talk about the scenarios and whether they are Sarbanes-Oxley compliant or not. And you may have to do some research on this one, which I think was probably a good point to do because this is a very interesting series of questions that we're going to be delving into. At least we're going to try to delve into it. I need to get over to the exhibits. All right. All right. The CEO established an audit committee 3 years ago. The audit committee consists of the CEO's brother, who's a middle school accounting teacher, his daughter, a college freshman majoring in finance, his neighbor, a retired school bus driver, and his accounting partner at college, is now CPA and partner in a national accounting firm. All of the audit committee members are members of the board of directors. The CEO pays a small salary to the neighbor, and the daughter compensates them for their time. The brother is a 30% stockholder and 30% owner in stock of Holcomb. All right. So are they Sarbanes-Oxley compliant in this scenario? What do you guys think? Yes or no? I see a no. Do we see any yeses? Do we see any shrugs? Answer, unfortunately, is no, they're not Sarbanes-Oxley compliant, okay? So first of all, the big one to note is this thing where they say that the CEO pays a small salary in favor of the daughter to compensate for the time. Basically, if you're on the audit committee, you can't receive any additional compensation other than what you already receive as being part of the board of directors, okay? And then there's also important to note that the audit committee members must not be an affiliated person of the issuer, okay? So somebody who has the ability to influence financial decisions, which the brother would definitely kind of constitute that as 30% of their stock Holcomb. So a couple of violations there. All right. 4 years ago, the CEO hired a top 10 national accounting firms to do the audit. The CEO plans to continue to oversee the audit firm's work that is now Holcomb Incorporated and is publicly held. Now the Holcomb's publicly held. CEO meets quarterly with audit senior manager to keep the auditor apprised of what's going on. So far, the CEO is happy with the work of the audit firm and senior audit manager, so plans to maintain that relationship. All right. So what do you guys think? Are we Sarbanes-Oxley compliant in this scenario? See yes. See no. See a maybe. The answer is no. We are not Sarbanes-Oxley compliant, unfortunately. What is the issue here? Well, who is responsible for communication with the auditor and resolving disputes with the audit with the audit? Is that going to be the CEO? Can the CEO do that, or is that those charged with governance? Those charged with governance, in a public company, we have a specific body that's charged with governance. That is called the audit committee. The audit committee actually has to do this role right here. So the audit committee has to actually be doing this. All right. Based on the recommendation of the HR director, CEO established an employee hotline reporting any concerns that have regarding accounting, auditing, internal controls. Concerned employees call the third-party service, Watson's Whistleblower Services, and report their issues. A Watson employee gathers information confidentially. The employees are allowed to report anonymously if they wish. Information then communicated to the board of directors, which includes the CEO. Watson follows up with the CEO and the board periodically until the issue is finally resolved. Are we Sarbanes-Oxley compliant with respect to this whistleblower hotline? Enthusiastically saying yes, Matt. Got some no's though. But Matt's correct, it's yes. It is yes. And we are correct here. So procedures must accommodate confidential and anonymous reports by employees of the company and as well as the receipt and retention of complaints and a method to address those complaints. Those are the guidelines according to the Sarbanes-Oxley Act, which both of those are addressed here in this particular issue. Both the CEO and CFO signed certain required representations about the annual report. The representations make a number of statements, including the following. Internal controls have been evaluated for effectiveness as of date within 6 months prior to the report. What do you think, guys? We think we're Sarbanes-Oxley compliant here? I'm going to say no. We're close. We're close. But this 6 months is a real problem. What is the number? What is the time period?
90 days.
90 days. 90 days is the period that we have to be actually with work. And so 90 days is actually the point in time which we have to evaluate their internal controls, and they were not within 90 days. All right. Another statement related to the annual report that must be signed by CFO and CEO. Following disclosures have been made to the auditor and audit committee of any material fraud that involves management and other employees with a significant role in internal controls. All right. What do you think? Well, probably you're going to be a little bit upset because they didn't put a space between committee and answer is no. We are not Sarbanes-Oxley compliant. Why are we not Sarbanes-Oxley compliant? Because it needs to be all significant deficiencies and material weaknesses in the design and operation controls. And any fraud, regardless of materiality, that involves management or other employees that have a significant role in internal controls must be reported as well. So it does not go far enough as far as the scope goes here, unfortunately. All right. The annual statement. Hold on, make sure I'm getting on the right here. The annual report, sorry. The annual report will contain a statement that management of internal audit function is responsible for establishing and maintaining an adequate internal control structure, procedures for financial reporting. This one's pretty much a gimme right here. Okay, who's responsible for establishing and maintaining adequate internal control in an organization? Is it the audit guy? Is it the internal audit function? No, it's the company's executives, which are also called the management. My goodness, this is something you should have known back in 417. So no, the answer is no here. Company's management is responsible for establishing and maintaining adequate internal control structure and procedures for financial reporting. Wow, that was disappointing. I think we're gonna have to redo this entire semester, guys, and I'm rebooting. Either that or final exam time. Goodness gracious. You have to step up your game in the last few here, all right? All right, Holcomb always has always had a code of conduct for employees at all levels of the organization. In the annual report, significant accounting and policy section of the notice of the financial statements will discuss changes or waivers to the code of conduct. Okay, is this in compliance with Sarbanes-Oxley Act? You're just nodding yes to everything, aren't you? Yeah. Answer is no. Answer is no. Why is it no? This one's one you wouldn't know otherwise unless you looked it up, because the only changes to the code of conduct that can only reported in the 8K. The changes to significant accounting policies are recorded in 8Ks, and this would be a significant accounting policy. So that'd be one. All right. All right. If we get this one wrong, guys, we're having a final exam. All right. All right. Here we go. You all brought this upon yourself with this management fiasco right up here. You guys should have known that. Should have been yelling that at the top of your lungs. All right. Holcomb's audit firm has maintained work papers audit for the past 9 years. Is this Sarbanes compliant, Sarbanes-Oxley compliant, Sarbanes-Oxley compliant? Yes or no? I have 1 yes, 2, 3, 4, 5, 6. What do you guys think? Yes? No? 7, 8. Yes. Lotus, what do you think? What do you think online? Hold on, let's go screen up. Okay.
You got
Are
it
you
in the chat.
Oh, that's in chat. Yes, yes. All right, Dylan, it's up to you. Dylan's gonna give you guys a final exam. Dylan says yes. Sydney's not online, so. Oh yeah, Sydney's not here, so we can't have unanimous. So apparently we just don't have it. Final exam there is. The answer is yes. All right, the answer is yes. Okay, has to be at least a period of 7 years. So 9 years is sufficient in that regard. Boy, you guys barely scraped by. Man, I'm so salty about this right up here. Okay, all right. I'll get over it though. I'll get over it. All right, we're done for today. We will be back on Wednesday. We have FTX starting on Wednesday. I'll see y'all then.